Hello, everybody. Welcome to this weekend's episode of the Weekly Wrap. This week's episode is episode 15. And today I'm going to be talking about how to invest through a recession and kind of what's happening right now and how you can be better prepared and come out on the other side of a recession better, and it'll help prepare you for tough times in the future as well. So I do want to say, if you enjoy this type of content, I release one of these episodes every single week, and it just goes more in depth about the markets and kind of what's just going on right now. And then every day that the stock market is open, I release a shorter episode just kind of recapping that day. So if you like that, subscribe on YouTube and follow us wherever you listen to podcasts. I do want to apologize for this coming out late on Sunday. Like I said in previous episodes earlier this week, I've been traveling this weekend, and I was actually on a couple flights back home earlier today, so I didn't get a chance to record till now, but I am happy that I'm able to bring this episode to you today because it's going to be a good one. So let's get right into it. How to invest through a recession. What's going on right now? Well, I want to start with that, and I want to look at some charts with that. So I want to compare this economy and this market and the S&P 500 to 2008. Obviously, there's a lot of parallels being drawn between the economies, what's going on with some of the banks, the housing market. But we have a stock market that's so highly correlated with 2008 right now. And if you take a look at this, we're actually right before, correlation-wise, that huge sell-off in the stock market. This is when Bear Stearns and the Lehman Brothers went under, and we had this huge decline in the market. And we're actually in a really similar setup right now in today's market. So I do think that that's interesting, and I think it's worth noting. You have a lot of algorithms and stuff trading on this market now, and the fact that all of these patterns are pretty much the exact same is definitely something that's noteworthy. Obviously, we have a Fed that continues to tighten extremely hard, and we're going to talk about this later in the episode, but you need to understand what the Fed's doing as well. That way, you know what to expect, whether something like this can continue to happen or not. And I do think that right now, the Fed is putting a lot of pressure on this stock market. We have an economy that's starting to crack, and the Fed continues to tighten harder than they ever have before. And I think that that's going to continue to have consequences, negative consequences on this stock market, whether or not we need them to continue to have this type of policy due to the inflation issues we're having. Regardless of what is happening in that realm, it's going to continue to negatively affect equities. Really, the whole reason this market turned around initially was because we had that pivot from the easy money policy. Interest rates have been zero for so long, and then they just started shooting up faster than they ever had before, and that's really what brought around this decline in the first place. So obviously, don't fight the Fed. We'll talk about that more later, so I won't continue to ramble about that, but it is important. So the U.S. government continues to refuse to admit that we're in a recession, but we're starting to see other indicators of a recession other than just the back-to-back quarters of negative GDP growth. The first being that the labor market is experiencing its first slowdown since COVID, and a weakening labor market is definitely a recession indicator. It's pretty much what the Fed has been looking to validate their tightening continuing. They've stated many times that the job market is still good, the economy is still strong, and therefore that they're okay to continue tightening the economy. But we are actually seeing job openings slow down for the first time in a while. And we're also seeing the recession probability model here on the right, and it's at its highest since 2020. The last time it was as high was 2020, and then 2008/9, and then obviously through the dot-com bubble as well. But we're getting all sorts of indicators that we're in a recession. Obviously, I believe that we are in a recession because the only true definition of recession is the back-to-back quarters of declining GDP because the economy is receding. So the economy is receding. We're starting to see other lagging indicators of that now. Whether or not the government admits we're in a recession or not, it doesn't really matter. But it is important to be aware of what's going on and to be aware that we are in a recession because that will have other effects throughout the economy. So I've looked at this chart once on the show, but I wanted to bring it up again because the Fed is really behind as far as a real interest rate goes. And the last time we had a real interest rate this low was in the mid-70s, and it took about 8 years to bring inflation under control. And even when it got under control, it took even longer to get back to the 2% target. So this could be an issue. Inflation could be an issue that stays around longer than we're expecting. It could be a little bit stickier than we're expecting, especially if something breaks in the economy and the Fed is forced to pivot or stop hiking interest rates. It's very possible that inflation continues to get worse. And it's important to be aware of those real interest rates. All that means is that inflation is outpacing the interest rates. So say inflation is 8% right now. A negative 6% real interest rate would mean that the interest rate that the Fed has is 2% or around 2%. Inflation is around 8%. Obviously, it's a little bit different than that, but it's around negative 6% right now. And that's not a good thing as far as currency debasement. Your money is losing its value every single year, even with these rising interest rates. Your money is losing value because inflation is outpacing the interest rate growth, and so your money is losing its value by about 6% per year. So before I get into this, I actually do want to kind of follow up on what I just said about your money losing its value every year. I just think it's important that when you understand that idea, it kind of pushes this narrative of owning assets. Obviously, you need sufficient cash flow to cover your lifestyle and your monthly expenses, and you also should have an emergency fund to cover anything that might come up that's not a normal month-to-month expense. But other than that, it's really important to have that extra cash flow going into assets such as investments in stocks or real estate or Bitcoin or other types of investments. It's just important to put that money somewhere where you have ownership, you create income, you create a compounding effect on your wealth, and you don't just let your money sit in a bank idle and lose its value, because you really only need cash to cover your expenses, and everything else should go into an asset. And in a market where asset prices are falling and the value of your money, if it just sits in a bank account, is decreasing, I can't think of a bigger incentive to buy stocks or buy assets that are at lower prices right now, because wouldn't you rather get assets at lower prices and rather do that than have your money just lose its value in a bank account? To me, that makes the most sense, and hopefully it makes sense to others as well, because that's really how you build your wealth. You put your money in places where it's going to grow, not where it's going to shrink in value. And right now you pretty much have to funnel that into some kind of asset that's not going to lose its value over time, because right now your currency just loses value over time. So let's look at market corrections since the 2009 low in the global financial crisis. The reason I'm bringing this up is because it is actually the longest downturn since that 2009 low. It's been slightly over 280 days now. We're at about a 25% decline. It's not the biggest decline. COVID was the biggest decline. We had negative 35%, but that only took 33 days. Right now, we're a little over 280 days and we're at 25%. So this is a more elongated bear market, more similar to what we saw in 2008 and 2009. And hopefully that means we won't see anything like it for a long time afterwards. But I'm not so sure about that because of what we do see the Fed doing right now. And if they pivot too early, it could spell some kind of disaster in the slightly near future. But hopefully we get through this and the market is a lot stronger because of it. A lot of times in big downturns or recessions like this, you see big players in the economy adjust and adapt to prevent something like this happening again. And hopefully we see something instituted by the Federal Reserve to where they don't let something like this happen again, because a lot of this is from their policy. They eased too hard for too long. Now they're tightening maybe too hard, and maybe they'll do it for too long. And they kind of just exaggerate these market cycles and make them more extreme. And they keep swinging more volatile in either direction. And it's not good for the economy. It's not good for the market. That's not what a free market is. It's not how it should operate. But hopefully they learn their lesson after what's happening right now, because really the whole thing is just fueled by the Fed policy. There wouldn't be inflation if we didn't have trillions of dollars being pumped into the system. So we wouldn't have to be raising rates during a recession if that were the case. We'd still be dealing with this Russia-Ukraine war and some supply chain fallout from the COVID crisis, but the inflation and rising rates aspect of this market wouldn't be here or wouldn't be as bad if the Fed was better at their jobs. But let's move on. And I'm just going to look real quickly at bear markets historically. We've taken a look at this chart before, but it is important to come back to just to understand the timeline. We're about 10 months in from the peak right now. Typically, the median for the length of a bear market is 18 months, and the peak to the trough is about 14 to 16. So we're getting close to that median and that average for the length of the peak to the trough, that bottom. And it's interesting because, like I said, we're getting closer to this correlation of this huge downturn that could lead us into the last few months potentially, and getting to a trough, getting to a bottom in the market. But it's just interesting how those things line up sometimes. And I think when you see some of those synergies in the indicators for the market, you need to pay attention to them, because history doesn't repeat itself, but it does rhyme, and you need to be aware of what's happened throughout history. That's why it's so important to study what's happened in the past. But typically we see 14 to 16 months peak to trough. We're at 10 right now, so that could indicate a little bit more time. And that decline to the trough is typically between 32 and 38%, and we're about 25. So again, that's lining up with this idea of a big sell-off event into a bottom happening as well. And then if we look at this chart on the right, it gives the duration and the price return through bull and bear markets. And you'll see that we're just barely in this recession. If you look back, that's the Great Depression right here. Obviously, that was more elongated time-wise. If you want to look at 2008, oops, didn't mean to do that. Sorry about that. If you want to look at 2008, lasted for about a year and a half, and we saw a 57% decline. And right now we're at a little over half a year, 10 months. So that number is actually a little bit larger now, and we're around 25%. But you do see huge bull markets come out of these bear markets. And that's why it's so important to continue investing and not get scared out, because this is not the time to sell. If you want to sell, these are the times to sell in these environments when the markets are going up. And not these times. These are the times to be acquiring the assets for better prices. So I want to finish up looking at what's going on right now with this chart before we get into more of how to invest through recession. I want to take a look at this because you do typically see really big bull moves through the end of the year, and especially during midterm election years. So it is possible we see some kind of a bear market rally through the end of the year. Maybe we come up and touch that trend line one more time before we see another sell-off. The technicals in the market and what we looked at earlier with the correlation to 2008 would say that we probably will not see a rally through the end of the year, but we typically do see one in a normal market, and we see an even bigger one during midterm election years, which we're in right now. And it's a very controversial and a big midterm election year, I guess you could say. So maybe you could see some kind of policy or orders coming out of the executive branch that would somehow move these markets higher into the midterms. So let's get into more of how to actually invest through a recession and come out on the other side best positioned for the bull market that will follow. So the first thing that you need to do is understand how the Fed affects business cycles. And you don't want to fight the Fed from the sense of going all in while the Fed is in a tightening cycle, and you don't want to short when the Fed is easing the economy and loosening the economy. So you need to understand why the Fed is doing what it's doing. So what does that mean right now? You need to understand why the Fed is tightening. You need to understand what the Fed is looking at when they're making their decisions so that you can predict what they're going to do. And then you need to understand how they're affecting the markets. So right now, the Fed is tightening because they want to get inflation under control. They want to destroy demand and bring prices down. And hopefully that'll cool off inflation. You need to understand that in a tightening cycle like this, stocks typically go down. And while that's bad for the value in the current environment of your 401k or your stock portfolios or whatever asset, it gives you better prices to enter and to invest. Now, you don't want to go all in while the Fed is tightening, but you do want to find some sort of dollar cost averaging that we'll go into in a minute. So you need to understand what would make the Fed pivot. When inflation starts going back down towards their 2% target, we could see a Fed pivot. And when the Fed pivots, they're going to be loosening the economy, and that'll allow assets to breathe and go back up in value because there'll be a lot more liquidity and demand for those assets. So welcome policy that brings lower entry prices. Don't be afraid of what's happening, because if you know what you're investing in and you believe in it, then the macro environment and what the Fed is doing, all it's doing is allowing you to get in at a better price. The market's not going to pay you a high price in an environment where the Fed is tightening like it is right now, but it will offer you a great price in the future. And that's really important. Because you don't want to get scared out of your investments. You don't want to sell them at bad prices and lose money. A lot of people get caught in that trap where they see the value of their investments going down, and instead of adding to them at good prices, they sell out and lose big potential gains. So my last point was just don't sell out during a tightening environment because you're not getting the best price for your asset. So number 2, you need to lock in on your investment strategy. Understand your strategy and refine your portfolio to fit that strategy. So it's easier to be more broadly diversified during a bull market because high tides lift all boats. When the market is in a really big bull cycle, when the Fed has an easy money policy, it's lowering interest rates, everything is going to go up in that environment. It's going to be easier to look like a genius and pretty much hold anything and have it go up. So in an environment that we're in right now, you need to really understand your investment strategy, what it means to you, understand the thesis behind all your investments, and really refine your portfolio to investments that you have a high conviction in. So you want to concentrate your portfolio not into a big bet, but into investments that you understand, have a conviction in, and that fit your investment strategy. You don't want to just be investing in risky assets that you don't understand. And you want to cut companies that might be in your portfolio that don't fit into your strategy. So if you've been invested in something and the thesis really isn't holding up on it, maybe something's changed in the company that goes against your investment thesis for it. You want to cut those companies or those assets out of your portfolio that maybe don't fit anymore and put them into your winners, your highest conviction investments, and you really just want to refine that. And that's the best way to position your portfolio through a downturn, in my opinion. So number 3, you want a dollar cost average through a recession. You need to stay consistent. Don't go all in at one time. Don't try and time the market. Just stay consistent with your investments. And the average price of that asset will go down through a recession. You don't need to try and time and get it at the absolute bottom. If you just invest consistently through the downturn, you'll get the same benefit from those lower prices. And if you need to stop looking at your account every single day, if that stresses you out and might pressure you to sell, then just don't look. Set up automatic investments and just don't look at your account. And know that you're doing the right thing and making the smartest moves. You can't be emotional through a recession or a bull market, really investing at all. You can't be emotional. You need to be strategic. And if that means not to look at your account, then don't look at it. And remember your investment thesis. Remember why you're doing what you're doing. You've looked at the data. You've done the research. You know that dollar cost averaging is the best investment strategy through a recession. And one way that I kind of manipulate dollar cost averaging in a downturn like this to get more capital into my highest conviction bets is, so in my Roth IRA, my HSA, and my 401k, I invest the same amount no matter what. So I'm always dollar cost averaging the same. But in my normal taxable brokerage, which holds any individual companies that I might hold in my portfolio, I'll dollar cost average the same overall amount into the portfolio, but I'll adjust the weighting of the allocation to what's cheapest. So if one company is really cheap compared to another one that month, I'll allocate more capital to it that month. Every holding will still get capital, but the amount that they get in that account will be adjusted based on the valuation. So in like 80% of my investments, it's getting the same amount every month and that consistent dollar cost averaging. And then just to make myself feel like I'm taking advantage of super cheap prices in specific areas, then I'll adjust the allocation in my taxable brokerage. And you can implement something similar to that as well. Obviously, do your own research before making any investment decision, but that has worked really well for me in the past, and the math backs it up. So lastly, don't listen to the news. News is built for clicks. It's built for views. It's not built for helping you become a better investor. They're going to try and scare you, that FUD, fear, uncertainty, and doubt. Stay true to your strategy. Remember your investment thesis, and be confident in it. Don't let the fear, the uncertainty, and the doubt sway your strategy, because the market pays those who are patient. Over time, the market's going to go up, and it's going to reward you for investing through these times. And the only way to build wealth is to get great assets at great prices and to never sell them. So with that, let's take a look at the charts. So the first chart I want to take a look at is ARK Innovation. This is Cathie Wood's flagship fund. And I want to take a look at it because it is at the bottom of where it was in the COVID crisis. So we're at about $33.99 right now. And the low intraday during this COVID crisis was around the same. And the low close was $34.69. So this is the lowest close on ARK since, oh my goodness. This is the lowest close on ARK K since, oh my goodness. It's going to go way back. Sorry, if you're listening to the podcast right now, I'm actually scrolling backwards on the chart to see when was the last time we closed lower than $33.99. And that day was September 27th, 2017 was the last time we closed below $33.99. And that was during a up market. So the market actually has never come back below that level since then. And during the COVID crash, we got below that level, but we didn't close there. So there is opportunity in some places in these markets. Her stocks have been punished, rightfully so, because it's hard for them to grow their businesses and their revenues in this current environment. But they are companies that will lead the way in the future. She calls herself the new NASDAQ. And I just think it's really interesting how much the market is punishing this fund and her holdings. And it can be a good opportunity if you believe in the space. So let's take a look at Apple now. Apple is obviously the biggest company in the S&P 500. And you can really kind of forecast maybe how the market will react based on what Apple's doing. So Apple's sitting on this support that held since June. The markets have made new lows since then, but Apple is not. It's kind of sitting on the top of that support. It bounced really heavy off the bottom of this support. Obviously, if Apple breaks through this zone, we'll map out the next zones for it, but that would lead the S&P 500 lower, probably much lower if Apple breaks through here. And maybe that could lead to some sort of capitulation event like we talked about in the beginning of the show, something that leads the market much lower. But it is important to know what's happening on Apple, in my opinion, because it does move a lot of the market. This is a range we've been in for a while too. So if you break through a range that you've been in for quite some time, it definitely can have some negative consequences on the price of the stock. So let's take a look at the next chart. So I want to take a look at the VIX because this is another reason why I don't think that the market has bottomed yet. Because typically in a market bottom, in a really big bear market, you see this capitulation event where there's a lot of panic, like we were talking about, similar to 2008. And in 2020, you can see that the VIX spiked all the way up to like 85. If we go back to 2008 and 9, it spiked to about 90. So in these bottoming events, you see the VIX spike, you see volatility and fear spike, and we haven't gotten that yet. And so that's what I'm looking for as an indicator of maybe when we bottom, is when we get this VIX 70, 80 plus. And we're kind of pushing on this. You can't really do technical analysis on the VIX, but we're kind of pushing on this upper level that we've kept bouncing off of as far as volatility goes. And maybe when we break through this, we'll see a spike in volatility and fear, and a huge sell-off in equities. So let's look at the S&P 500 now. It came up to this resistance and sold off. Again, if Apple breaks through that low, it could send the market back down to this 3250 that we've talked about. Maybe eventually we also get a channel line hit. I wouldn't be surprised if we saw that. If we do end up seeing the other side, if we end up seeing a bull market, or not a bull market, a bear market rally through the end of the year, an October, November, December holiday season rally, maybe we find our way up to this trend line, and then kind of sell off. But right now it's looking pretty bearish. We're sitting on this resistance line right now. A break would be good. That would be a pretty bullish move to have a break back above this resistance right here. But a more likely scenario is a move towards this zone in the 3250 range for the S&P 500, especially with any weakness that might come out of Apple. So that will play a big part in what happens in these markets. And last but not least, I want to talk about Bitcoin. So right now we're technically through this trend line, but we did mention on Friday that we wouldn't be surprised to see the market just kind of stay flat and go through this trend line over the weekend. And then if the market sells off on Monday, Tuesday, to have it come back down and snap below. And then maybe if it snapped below and was started to put pressure on this 17.5, 17.7 level right here, it would have a difficult time, and that could be something that could push it through. And we've talked about how the 12,000 to the 9,000 is really that next level for Bitcoin, because there's no support anywhere on Bitcoin until you get to like 12,000, 9,000 level, that range. And while that would be a really great buying opportunity and a really great investment scenario, right now it is really risky to put your money in up here at 19,000. You could get way better prices in the future. We are not surprised that this trend line has been broken through over the weekend, and if the market sells off, I do expect it to come back down below that trend line. So that's what I'm looking at as far as the S&P 500 and Bitcoin go, kind of both sitting on resistances, and it's more likely than not that they kind of bounce off those resistances and maybe see some more weakness. So that's all I had today for you guys. I really appreciate you watching or listening to this episode. If you liked it, please subscribe on YouTube and follow us wherever you listen to podcasts. I release an episode like this every single weekend, and a shorter episode every single day that the stock market is open, just kind of recapping what happened that day. I hope you took something from this episode and it helps you invest through this recession and any recessions to come. But until next time, I appreciate you watching or listening to this episode, and I'll see you in the next one.